Welcome to Market Catalysts. We are 30 minutes into the U.S. trading day. Let's get to 3 market catalysts that we're watching this hour. First up, President Trump's tax bill facing an uphill battle in the House. We break down everything you need to know about the bill. Plus, trade deadlines, they loom over investors with just days for the U.S. to make deals with top trading partners. Details to come there. And Figma files for its IPO. We break down the state of the market for initial public offerings and much more ahead on Market Catalysts. Let's get a check of the markets as we always do. 30 minutes into trading activity here on the day. We are mixed, folks. Take a look at that Dow right now. It's down by about 0.2%. However, we have found our way into positive territory on the S&P 500. That's flat just barely to the upside there. And then the NASDAQ, you're also seeing that in positive territory as well by about 0.25%. We're seeing some hyper oscillation within the S&P 500. We'll keep close tabs on that. It's already been a week where we've seen some record highs. We'll see exactly what is ahead for the rest of today's trading activity in this holiday abbreviated trading week. Also here, let's flip on over to the bond market. Take a look at yields, 5, 10, and the 30-year yield moving higher here on the day. And as we're taking a look at some of those moves to the upside for treasuries, it's just about 2 basis points for the 5-year, 4 basis points for the 10, and then additionally 6 for the 30-year, as we're getting even more of the economic data over the course of this week. And it's going to be bookended with that BLS, Bureau of Labor Statistics employment situation report to come on Thursday ahead of the holiday. Well, President Trump's big, beautiful bill is back in the House of Representatives. Senate Republicans passed their version of President Trump's big, beautiful bill in a 51-50 vote, with Vice President J.D. Vance breaking a tie. With more on what happens next, let's go to Washington correspondent Ben Werschel. Ben, what do we know?
Morning, Brad. Yeah, so House consideration is very much in full swing already this morning here in Washington. The Senate, they came into the session about at 9 a.m. this morning, so they've been talking for about an hour, and the focus this morning is setting the rules for the coming debate. This is all, of course, to tee up a vote on the Senate bill. Speaker Mike Johnson and other leaders want to pass this bill as is, which is basically the only path to get it to Donald Trump's desk by his July 4th deadline. The timing is very much up in the air. One factor that's under close watch this morning is the weather. Storms are delaying a lot of lawmakers coming back. But the bottom line is this is going to happen either later today or early tomorrow, Johnson says, to pass this bill exactly as it is and get it to President Trump's desk. Whether that's successful is a much more open question, as there's a lot of Republicans who are unhappy with this. The sort of political question this morning is not whether House Republicans are unhappy with the changes the Senate made. They're very testy about that, I can tell you. It's whether basically they're willing to cross President Trump on this, who wants this bill done, who wants to even potentially have a signing that by the end of this week. Punchbowl News has a really good tracker of this, and they tally about 28 Republicans at the moment who are either saying they're not going to vote for the bill, not saying, very quiet on this, or have a lot of questions about this. Mike Johnson needs to get that number down to about 3 by the time the vote happens. I will say we've seen this movie sometimes before, where a lot of Republicans say they're not going to vote for this and then get pushed in the end to do it. So we'll see if Johnson's able to do that. The big objection here is over the price tag. This bill comes back to the House with about $900 billion in additional costs. Then when it left the House, that gets fiscal conservatives really up in arms about this. And we've already seen members of this Conservative Freedom Caucus pushing back against this. We saw 2 defections last night in the Rules Committee as they debated this. That doesn't mean they're going to vote no on the floor, although one says he will vote no on the floor in the end as they push this. The bottom line here is that Trump has cleared his public schedule for the day to twist arms. He's going to push hard on that. The bill is very likely to pass at some point this month. The question is whether they push it through exactly as is or go back and forth some more throughout July.
All right, Ben, thanks so much. We're going to continue to track this, especially as we're continuing to get some live shots of Capitol Hill. Appreciate it. Well, getting the Senate bill through the House of Representatives without further changes is a major test for Speaker Mike Johnson, who must win over the many divided factions within the GOP's slim majority in the House. Speaker Johnson, in a statement on social media, vowed to get the bill passed by President Trump's July 4th deadline. But how realistic is that goal? Joining me now, we've got Matthew Axe, who is the Evercore ISI senior strategist here. And we'll start there. What is the probability of us getting this over the goal line and ultimately the GOP factions that are disagreeing or dissenting in some form of another with each other actually coming together and ultimately getting this to the president by his self-imposed deadline of July 4th?
Well, I do think we're in for one more kind of turbulent, volatile week here as the members of the House maybe take one last chance to try to put their mark on this bill. I do think at this point it's better than even odds that they are able to muscle it through. I think Trump, you're seeing someone right now who's really at the peak of his political powers. We saw what happened in the Senate when any sort of member of Congress chooses to defy him on this legislation. And so if I had to bet right now, I'd bet on sort of the peak of Trump's powers overcoming some of that resistance and Trump getting his big celebration on July 4th. But it's going to be a bumpy and volatile couple days here, and there's going to be a lot of noise coming out of the House for sure. Okay, so why should markets care about this then? Because the other consideration, too, is what we've heard in terms of the price tag for this bill and how investors are trying to think through what this means for the economy. Yeah, well, I think this bill has enormous, far-reaching implications for the economy. I think it is going to provide a significant boost to consumer spending. There are significant incentives for business investment. But then I think there are some real challenges created in specific sectors, in healthcare, in renewable energy, where you're going to see a lot of the incentives sort of phased out very quickly here. And then, of course, this all comes against the backdrop of a fiscal situation where the U.S. has an elevated fiscal deficit. And the bill, doesn't really do anything to address that. It includes a lot of spending cuts, indeed, but those are swamped by the tax cuts. And so ultimately, this bill, you're trending towards a higher deficit. So I think there's a lot of moving pieces here. And, markets will have to unpack this sort of near-term kind of sugar high from the consumer tax cuts and then what it means for the long term in major sectors and for the U.S. fiscal outlook. What is the significance of some of the cuts within what is essentially kind of renewing and cementing some of what was already in the Tax Cuts and Jobs Act in the first Trump administration as it pertains to corporate businesses and enterprises? Yeah, absolutely. So we're going to go back to businesses being able to fully expense their R&D investments, fully expense their equipment investments, and then also a new incentive where if you build a factory, you'll get 100% depreciation for that factory as well. So I think all told, you're going to see a pretty big boost here to business cash flow. It's not a corporate rate cut like what we saw in Trump 1.0 when they took the corporate rate down to 21%, but these new depreciation allowances will definitely cut effective rates for corporates, especially in capital-intensive sectors, R&D-intensive sectors, and manufacturing. And so it seems like markets might even well be looking through the passage of this and anticipating that it's going to come over the finish line. So with that in mind, what's the portfolio positioning that you're kind of monitoring how investors are making sure that their trades align with some of the elements of this deal? Yeah, absolutely. Well, so I think, first of all, I would encourage investors to really be on watch for the kind of negative impacts which are going to be felt in healthcare and in renewables. I do think that those are going to really be a major factor that we're going to be talking about over the next 12 to 24 months as these new policies and cuts kind of phase in. So I think that's probably the number one kind of risk factor to monitor. In terms of the consumer spending, the business tax cuts, look, I think this is an economy that is already kind of grappling with the impact of tariffs. I think in a lot of ways, the consumer and business tax cuts here may ultimately kind of lead to a treading water when you also factor in the tariff effect. And so I think net, I see a kind of immediate optimism, but I do think there is reason to be cautious here over the next 12 to 24 months. Wow. Okay. So within that caution over the next 12 to 24 months, what does that also factor in about how the consumer backdrop as well is really going to have to take all of these things into effect? Because now we're talking about everything from Medicare being impacted to SNAP benefits. This is going to have a significant and tangible economic delta here. Yeah, absolutely. Look, I mean, if you bought a car this year and you've been paying your auto loan interest or you're a senior citizen, you're absolutely, when you go to file your taxes next year, going to get a much bigger refund than you had maybe planned. And that undoubtedly is going to be supportive to the economy. But as you're saying, there are a number of headwinds here. I think the healthcare cuts and the SNAP cuts will start to have an impact. I think with some of the support for wind and solar energy being pulled back, you could start to see higher energy prices come into play. And then I'm also watching the student loan piece. We already know that the Trump administration is starting to put existing student loans into collection. And then this bill will change the repayment plans for a lot of student loans, even if those student loans are still current. And so I do think it is a mixed picture, and that's before you even get to the tariff story. So I think net here, you're looking at kind of a sugar high next spring when a lot of folks get their tax refunds. But then beyond that, a very, very mixed picture with a lot of different puts and takes happening.
Okay, and so just to kind of cap off this conversation, in the spat that we've seen continue to play out between Elon Musk and President Trump, is Elon actually right? And I raised my voice at the end of that because he's talking about some of the areas within this that are actually impacting what are the future-looking investments and where we should be investing in more innovative solutions for the economy and just more broadly.
Yeah, absolutely. Look, I think Elon, he pointed out, I think, something really important here, which is that right now, we're in a situation where we have AI data centers coming onto the grid. We need more power. And the fastest to deploy resources right now are going to be solar and battery storage. And you're pulling back incentives for solar and battery storage, right? So I think that point that Elon identified, I think, is really important. In the version of the bill that the Senate, passed, they literally at the last minute made some changes to kind of remove some of the toughest aspects on wind and solar. But still, this is a major clawback of what those companies had been planning under the Inflation Reduction Act tax credits, thinking they had a full 10-year runway here of incentive for wind and solar. That's now very much in doubt. So I do think Elon put his finger on something important. There was an effort a little bit to kind of discredit him, say this was about EVs, but I do think his point about the power generation and the need for more electrons is a really important one.
Well, in some senses, he has himself to thank. Matthew, we'll have to leave the conversation there. Thanks so much.
Thank you.
I want to bring in my contributor, joining me throughout Market Catalyst, Brianne Lynch, who is the Equities and Head of Market Insight. Great to have you here on set with us today.
Thanks for having me.
Absolutely. As we're thinking through multiple factors that the markets are considering right now, pressing most, I think, on some of this sentiment is really what is taking place with this tax bill and where we're seeing arguments made both from corporate elites as well as some of the politicians who are voting on this. What's the read-through from the Equities and desk and the team as you've been discussing it and evaluating?
Sure. So we're really looking at this from a private markets perspective and wondering how does this bill impact the companies that are growing in the private market. So while there are things that may be changing last minute, what we can say pretty confidently is that this is going to be a good opportunity for defense tech companies. There's a lot of defense spending that is part of this bill. We've seen Palantir and other public stocks run up because of that. And then in the private markets, we've seen increased interest in these private defense tech companies because of that. So think of Anduril, Mach Industries, Helsing, companies that have really taken advantage of this opportunity, and we see big growth potential for them given what's in this bill.
And so with that in mind, as you're looking across these companies, is there one that is really positioned well? You mentioned defense, and defense is particularly interesting, especially with some of the spending carve-outs within this bill. How, though, for those industries that might be impacted, is there even more of a need for them to solidify some of the capital that they're getting right now to really navigate what types of changes could impact them in this bill as well?
Sure. So I think one of the benefits for companies, even when there is uncertainty around this, is the R&D spending piece. So companies that are innovating and are investing in future technologies may be able to get tax benefits because of that. So even let's say you are in solar energy or renewable energy and there's a downside to what could come out of this bill, there may be a little bit of a silver lining. And I think for tech companies that are looking to innovate and grow, that could be the opportunity.
Brianne, stay with me. We've got much more to discuss throughout Market Catalyst here. We've got all your markets action straight ahead. Stay tuned. You're watching Yahoo Finance. Time now for some of today's trending tickers. We are watching Oscar Health, Verint Systems, and Apple. First up, Oscar Health shares plummeting today. Barclays initiating coverage of the stock with an underweight rating, citing policy risks that could impact the health insurance company's growth and margins. Raymond James also downgrading the stock to market perform from outperform, also citing policy risks as tariffs, expiring subsidies, and funding cuts weigh on sentiment in the healthcare industry. Meanwhile, Verint Systems is soaring on the back of a Bloomberg report that buyout firm Thoma Bravo is in talks to acquire the company. Verint is a New York-based company that makes call center software, and according to its website, it's a leader in customer experience automation and serves about 10,000 blue-chip customers in more than 175 countries. The company has been listed on the NASDAQ Stock Exchange since 2002, NASDAQ stock market. And finally, Apple getting an upgrade at Jefferies to hold from underperform and a price target raise to over $188 from $171. The firm saying that it believes strong third quarter earnings could, quote, keep the stock stable near term. Weak iPhone sales and problems developing artificial intelligence services has dragged on Apple stock this year. Shares are down about 15% since January. You can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's Trending Tickers page. President Trump's self-imposed July 9th deadline for making trade deals is inching closer. And while the president recently said he doesn't expect to extend that deadline, he also says he's not confident the U.S. will get a deal done with nations like Japan, floating the possibility of a higher tariff level. Here with some analysis and ways to manage your investments amid the uncertainty is Paul Eidelman, who is the Russell Investments Global Chief Investment Strategist. Still with me here, we've got Brianne Lynch of Equities and the head of Market Insight. Great to have you both for this conversation. So, Paul, I want to begin with you as we're hearing even more around how investors are thinking about what could be this average tariff rate. We had Jennifer Lee of BMO tell us earlier this week and remind us that we began at an average tariff rate of about 2% at the start of this year, and now we've essentially 8x that at this juncture and are still waiting for that to come down with some of these deals. How are you reading through that?
Well, I think there is a little bit of uncertainty here into next week around what exactly happens with the tariff pause, but our sort of assessment based on the guidance that we've been given from Treasury Secretary Scott Bessent is it seems like a willingness to give more time for countries that are negotiating in good faith with the United States. And that seems to apply to most of the United States' key trading partners here. So by our estimate, we're probably tracking an effective tariff rate of something like 15% for the U.S. economy going forward. As you mentioned, that's notably higher than what had been prevailing for the U.S. over the past several decades. It's the highest tariff rate since the 1930s. But even with that, our analysis suggests the impacts onto fundamental growth are very likely to be manageable here. We're tracking a hit to real GDP growth, for example, of something like 0.6% over the course of 2025. And so I think for an economy that was coming into the year growing something like 2%, that's looking like a manageable hit. It's still a headwind, but our expectation is that the U.S. economy and corporate fundamentals, for that matter, can very likely power through this tricky period with slower but still positive growth in the year ahead, even with these higher tariffs.
And so, Paul, I just want to follow on that for a hot second and get your anticipations going into this next earnings season, what the tenor might be from companies, some of them who had to pull guidance or also provide a range of guidances, two different scenarios from the public market companies that we will hear from.
I think earnings have been really a bright spot here, frankly. There's been enormous anxiety in the market, enormous uncertainty, both from investors and the C-suite around this ever-evolving trade policy and other issues. But if you look at the first quarter, that was an excellent earnings season in terms of delivery. We got almost 14% earnings growth for the S&P 500 index, which was well above consensus expectations. And I think as we're sort of tracking into the second quarter here, two things stand out to me. First, we have a pretty low bar in terms of consensus estimates that are only looking for something like 5% growth. I wouldn't be surprised if we ended up seeing high single digits or maybe even double-digit earnings growth in the second quarter. And then maybe even more important than that, as we've started to get a moderation in the sort of tone and volatility around trade policy, those forward earnings estimates out over the remainder of 2025 and 2026 have started to stabilize, if not tick up a little bit for the U.S. equity market. Some of that is strong results from the mega cap tech companies, and some of that is also just a broadening optimism that the fundamentals look like they're showing some resilience here and might be able to hold in despite all of the volatility from policy.
And Brienne, I guess to that same end, what are we hearing, to the extent that we can? Because on a quarterly basis, we expect to hear from the publicly traded companies and how they're working through some of these matters. But I guess what are the murmurs, or what are we hearing to the extent that we are from private market companies that are also navigating through the same set of issues?
I think, one of the benefits that private companies have is they don't have that daily mark-to-mark that public companies have. So they're able to maybe be a little bit more strategic and take some of these longer-term bets versus worrying what the next day, what the next quarter might trade like. A lot of these companies are focused still on building their fundamentals and preparing themselves for an eventual IPO. So in a market where there is still ample capital available to these private companies, less of a headwind for them, but certainly something companies are watching.
Paul, as you were mentioning that 15% effective and kind of average tariff rate that we could be anticipating and that your team is really modeling out for, what are the sectors that show the most resiliency as investors are thinking about it for their portfolio?
Yeah, well, I think in the aggregate, we're seeing resilience across the earnings picture. We're still seeing consumers engage in the economy here into an environment where there hasn't been a notable pickup in private sector layoffs just yet. So I think there is still a stay invested theme that's appropriate at this moment in time. Around tariffs and trade policy uncertainty more generally, definitely still some question marks, but as we sort of talk to our money managers and where we're seeing value in the market into this picture, I think some of the areas that stand out to us are financials into an environment of healthy fundamental growth. We think that's a sector that's supported and could have some tailwinds here as well from an improving regulatory backdrop, with the Federal Reserve recently discussing some trims and modifications to the supplemental leverage ratio, for example. So financials are an area of interest. We're also focused on global diversification in portfolios because we do see some risk towards a weaker U.S. dollar over the next couple of years. And I think that sort of amplifies the case and role that globally diversified allocations can play in investors' portfolios going forward.
Paul, good to see you. Thanks so much for taking the time. Brienne, sticking with us. We appreciate the insights. We've got all your markets action straight ahead. Stay tuned. You're watching Market Catalysts. One hour into the start of trading, let's go live to the NASDAQ to get a read on the biggest factors moving markets today. Joining us now, we've got Brooke DePalma. Hey, Brooke.
Good morning, Brad. 1 hour into the trading session, and what we're really seeing here is this muted reaction to this morning's ADP report, where we saw 33,000 jobs lost in the month of June, and perhaps investors here taking a cautious beat ahead of the Bureau of Labor Statistics report set to come out on Thursday morning ahead of the 4th of July holiday. But one thing I do want to point out is breaking here, President Trump taking to Truth Social to say, quote, "I just made a trade deal with Vietnam. Details to follow here." And so I want to take a closer look at key sneaker giants. I want to think Nike, think On Running. I also want to take a closer look at perhaps Skechers here, mostly muted. But if you take a look at Nike and On, also take a look at Deckers. What we're really seeing here is these stocks moving higher, up roughly anywhere between 3%, 6% even for On Running. Vietnam is where it makes all of its shoes, or majority of rather. Also taking a look at Decker moving 3% higher. This market, Vietnam, is a key market for these sneaker giants. The fact that a deal has been reached, of course, we're waiting to see what exactly the tariff, the duty on these sneakers will be. But this is big news for the retail sector at large. Really, the reaction here from the street largely muted, as once again, investors really look to hear more economic data that could ultimately impact the Fed's decision come July.
All right, Brooke, a lot to continue to track here, especially as we were looking for trade deals like this to be announced before that July 9th deadline here, and seeing the immediate reaction in some of those very names. We appreciate it. Design software maker Figma filed to go public, the latest company to test the IPO market. In recent weeks, financial technology company Chime Financial, crypto firm Circle, and space and defense technology company Voyager Technologies received debuts, and they were well received, and they've reignited some optimism in the market. With a broader look at the state of the IPO market, we've got Brianne Lynch, who is the Equities and Head of Market Insight here. So let's just start on the news here with Figma and the significance of a company that was set to be acquired by Adobe and is now, after that, set to make its IPO debut.
Sure. This is an example of one of these late-stage private companies that has been waiting a very long time for an exit. So they've certainly been putting the pieces in place. That was a 2023 acquisition that didn't pan out, and they're in a position of strength as they look to go public now. It's reported that their Q1 revenue is up 46% year over year, and while their most recent private market mark was about $12.5 billion, so certainly a decrease from that 20 billion number that they looked at in 2023. With the growth they're seeing, there's an opportunity that the valuation has grown as well. So kind of against all odds, we've seen companies that have strong growth narratives and profitability decide to test the markets.
I'm glad you mentioned that profitability component here too. What type of demand is there for these companies that are making their way into the public markets right now to already showcase that they are profitable versus what we had seen 5 to 7 years ago, where a company, if they were in a unicorn or decacorn status and weren't profitable, but at least could sell the markets that they would soon be profitable or had a pathway to it, they would get some type of positive reception. What is the delta between the mindset that we're seeing for investors between then and now?
Sure. So the mindset has totally changed.
Yeah.
The growth at all costs era has come to an end. And what's interesting is while a lot of these companies are already profitable, Figma being one of them, we did see a few IPOs this spring of companies that were not yet profitable. But to your point, they were close on that path to profitability with narrowing losses and a very clear picture that they could show investors to get there. So profitability is kind of the gold standard, and I think that's what most companies are exhibiting or at least very close to showing.
Your outlook for the back half of this year, based on what we've seen in the first 6 months of 2025 here, what are the companies that investors are still clamoring for to make their debuts and the type of strength that we could see in the IPO market here?
Sure. So there's a few names that are on our radar in particular. Gemini is one, looking to make some of that Circle momentum potentially benefit them. Klarna, a big name that we've been waiting for a very long time, looking to go public this fall. And then Navan's another one that's confidentially filed and looking to go public. And there's so many of these late-stage private companies that are 10, 15, 20 years old where the broader investment market has been waiting a very long time to access them. So for those companies who have signs of strength, this fall may be the time.
Brianne, thank you. Excellent breakdown, and we're going to be looking forward to seeing some of those companies make their debuts on the NASDAQ or the New York Stock Exchange. We will see. We've got all your markets action ahead. Stay tuned. You're watching Market Catalysts. It's time now for our chart of the day. We're tracking Tesla deliveries in the second quarter, falling short of estimates. 384,122 electric vehicles were delivered in the quarter, making for a 13% drop from the prior year. But it is a step up from the first quarter here. And so taking a look at some of the historical performance and where the forecast actually was for 389,000 deliveries in the second quarter, we fell short of that. But taking a look at the quarter-over-quarter performance, we did move higher. So let's take a look here as well at some of the weakness that we've also seen in some of the previous second quarters of the year. So in 2025 here and out of the gate, of course, you had that sluggish Q1. And relative to years past, where does the second quarter typically stack? Well, the second quarter typically, yes, outpaces Q1, but at the same time, the strongest quarter of the year typically comes in the fourth quarter for Tesla here, as they've been able to continue to have a solid trend line higher. The larger question is, how will EV sales continue to move forward, as we've seen some big declines in the latest auto sales data as well? And so that in mind, as well as the consumer mindset, where they're hearing everything and we are hearing everything from vehicles that are being put on lots that have tariff-free prices versus those that actually are incurring some type of price rise because of and talked about due to tariffs. That's where the consumer mindset certainly has had to ingest a lot over the course of the first 6 months in 2025. And we'll see what holds for the back half and if history can repeat itself and the Q3 and Q4 performance trend continue to the upside for Tesla. But this also comes as we are going to be watching closely to see how electric vehicles are performing in the roll-off of some of the specific programs that would offer rebates to consumers who are opting in to that type of vehicle. Well, EV sales seeing big declines in the latest auto sales data as tariffs rock the industry. Ford reporting EV sales down 31% year over year in its second quarter. Tesla deliveries down 14%, and Rivian falling 23% in that same period. So what's ahead for the industry with cuts to EV tax credits coming in the GOP budget bill? For more on that, I've got Ron Yepsichal, who is the Guggenheim Securities Director of Automotive Equity Research. Great to have you back on the program with us. So just take us into your assessment of the bill that's making its way through Congress and ultimately what that could mean and what you're tracking that up against for the mindset of the consumer if we see less of these rebates available to EV owner hopefuls out there.
Yeah, I think the things investors are most focused on, and thanks for having me as well. I think the things investors are most focused on related to legislative changes are how much the loss credit impacts demand, particularly as most manufacturers, Tesla, Rivian, and legacy OEMs included, have leaned into really to leasing, which was, at least by I think the letter of the law or the IRA was a bit of a loophole in terms of how it was viewed. It was a bit favorable. How leasing gets impacted because you have seen manufacturers lean into leasing quite aggressively as a way to move vehicles at more attractive monthly costs to consumers. But yeah, I mean, there's no denying that if a Tesla vehicle effectively to a consumer becomes 13 to 14% more expensive, it's going to negatively impact EV demand. And that is something that we'll have to wrestle with if and when the One Big Beautiful Bill passes, and we'll see where things go.
And so what are we anticipating from the rest of the car manufacturers in terms of their propensity to invest further in R&D into some of the electric vehicle ambitions that they've been vocal about in recent years, but have since stepped off of being as aggressive on some of those ambitions?
Yeah, it's a good question. I think what we see, at least particularly in our supplier coverage more than anything, is there is booking slowdown in electric vehicles ex-China. And I would expect that to continue, all else equal, given legislative changes and, frankly, just consumer demand pushback on electric vehicles even before the Inflation Reduction Act's potential repeal. So I think that you've seen the legacy manufacturers lean into hybrids, lean into ICE vehicles, and potentially lean into range-extended electric vehicles, which are effectively plug-in hybrids. But I would expect a pretty material slowdown in EV investment, at least ex-China, over the next several years, just because, frankly, the consumer demand's not there.
With some of the elements in this bill that either target EVs or target solar and some of the more innovative technologies that we were anticipating to be scaled up, if that is reduced in spending ambitions, how does that also impact the broader kind of not just scalability, but the infrastructure that's necessary for people who do want to purchase EVs in the future?
Yeah, it's a good question. I think charging broadly has been an issue, at least of consumer perception of electric vehicles, the availability of charging and charging speeds. But ultimately, I think this is something where demand of electric vehicles will drive charging or lack thereof, not necessarily regulatory incentives. It certainly helped the companies building out the infrastructure. But if EV demand is there, which I think is the ultimate question here, charging infrastructure will get built out because you do need it to kind of facilitate adoption.
I was taking a look at some of the data from Edmunds, and the number 3 vehicle of the year, at least in 2024, was the Tesla Model Y. For Tesla specifically, as we're thinking about them, because they have been able to be the annex kind of mindshare name that comes up in a lot of people's heads when they think about EVs. It is Tesla, and for the Model Y, it's largely the same, 75% the same as the Model 3. What does Tesla need to do in its next ambitious release, especially as they've been teasing yet another mass market vehicle?
Yeah, it's a good question, and it is, I would say, one of the most frequently asked questions we get from investors is what to expect from the new low-cost model. We were expecting to see it in the second quarter, not necessarily sales, but at least have the vehicle unveiled. So I think it's something that we would expect in the near future based on Tesla's historical commentary. Our view has been it will be somewhat lower cost than if you think of the Model 3 as an entry point as a high $30,000 vehicle. This can get down to something like $35,000 to the consumer in kind of a base case. But they are limited in what cost they can take out with the new affordable models because it's not using the unboxed manufacturing process, which was kind of going to be a revolutionary step change in costs. It is being built on, we assume, the same platform as the Model 3 and Y. They've said it's being built on the same production lines, but we're assuming the same platform. You're kind of limited in how much cost you can ultimately take out. And Tesla's cars are already pretty minimalist in terms of their approach to the consumer. We've struggled with exactly how much content you can take out of the vehicle to get something materially lower than the mid $30,000 range to the consumer.
Okay, and that was the core question that I was actually going to just follow on real quickly, what the price range needed to look like, and knowing where this ranks, especially as Tesla is just coming off of its major robo-taxi event where it's trying to make sure that investors are essentially seeing some of what's been talked about come to fruition finally, but these deadlines that they have set in the past, they typically don't get met. So what is the drop-dead deadline for them to ultimately show investors that they're able to release this new mass market vehicle?
Yeah, I don't know if there is a drop-dead deadline. You're not seeing a terribly meaningful reaction to deliveries this morning, at least in terms of how much better it was than buy-side expectations, which were probably 5 to 6% lower than where the number came in this morning. I think investor focus is much more on the robo-taxi business. But I think as you think about positioning for the new affordable model, in the US, it will be very attractively priced relative to EVs, but ultimately we think it does cannibalize some Model 3 demand, just your lowest marginal cost buyer looking to shift down into what we expect to be a more affordable vehicle. In China, the pricing's still going to be too expensive to compete with the likes of BYD, and really where there is the most demand in China, which is sub 150,000 renminbi. We don't expect the vehicle to reach that price point. It would be a dramatic price cut from where the Model 3 is priced in China currently, and so we don't see it really unlocking a lot of demand, at least in China.
Ron, thanks so much for taking the time here. A lot of implications here for Tesla investors to consider here. Appreciate it.
Thanks for having me.
Certainly. Coming up, a look at what the second half of the year could bring for the ETF market. More when we return. In the first half, over $500 billion flowed into ETFs in the U.S., putting them on pace for a record-breaking year. But guess what? There are some signs that could suggest investors are still cautious. I want to bring in Aniket Ulal, who is the CFRA Research Head of ETF Research, for this week's ETF report brought to you by Invesco QQQ. Aniket, great to have you back on the program with us. First and foremost, as you're thinking into the second half of the year, how much of the second half might rhyme with the ETF flows that we saw in 1H of 2025?
We expect, generally we've seen every year that the second half of the year tends to be stronger in terms of flows, particularly the fourth quarter. So, if you'd asked me at the beginning of the year, would we repeat this $1.2 trillion of inflows from last year? I would have said no. Now we've kind of revised our opinion. Flows have been much stronger than we expected, driven, of course, partly by the rebound from the 8th of April that we've seen in the markets, and also partly just driven by secular trends of continued shift from mutual funds into ETFs. So at this point, I think we're on track to beat the $1.2 trillion of last year. Of course, things can, there's always uncertainty out there, but at this point, we expect to be at least in the above 1 or 1.2 trillion for the year in ETF flows.
With that in mind, I wonder how much of that is also driven by investors who might be looking for either a sector-specific approach or just some type of diversification versus stock picking, and how difficult that could be when you do have the extremely volatile moment like we saw at the beginning of Q2 in the Liberation Day, and investors really trying to figure out, okay, how can I make sure that I'm diversified and hedging some of that risk?
That's a great point. There are a couple of things that have stood out this year in the first half. One is that it's really retail investors who stayed invested in the market. What we've seen is that retail investors have been patient, they've bought the dip, and that might be partly because they've seen that a lot of the downturn we saw in April was policy driven as opposed to fundamentals driven. And so, they stayed patient. If you look at just a very simple proxy is to look at S&P 500 ETFs. There's 4 ETFs that track the S&P 500. 2 of them are more retail oriented and 2 of them are more institutional oriented. What's interesting is that the retail oriented ones like VOO and SPLG actually have seen consistent inflows every single month this year, whereas the institutional ones have been more volatile in terms of flows. That really shows us that retail investors have been patient, have stayed in the market, and that really is a good sign in terms of going forward. So that's to your point about investors wanted to be diversified. We have seen retail investors stay invested. We've also seen more interest in active management. Active ETFs account for less than 10% of ETF assets, but this year have accounted for over a third of the flows. So to your point, I think investors are looking at how have some of these events like tariffs affected active management, and is there more scope for active management in the ETF space?
Aniket, I love in your notes one of the catalysts that you point out here, and it is the SEC approval for ETFs as a share class of mutual funds and what that could do in terms of ETF assets further from here. What is the anticipation there and why is that significant?
One of the things that's really surprised everyone in the industry is how open the SEC has been to approving ETFs as a share class of mutual funds. So essentially, this is where mutual fund managers who have an existing mutual fund can now launch an ETF as a share class of their mutual fund as opposed to an entirely separate product. This could open up move a lot more assets from the mutual fund space into the ETF space. It also opens up from the asset manager's perspective a new channel where you can offer ETFs to generally ETF investors tend to be, a kind of younger demographic. So both from the asset manager's point of view and the investor's point of view, this could be a big growth area and could give a further boost to ETF assets. I think the challenge here is going to be in the implementation, because you've got broker dealers and other intermediaries sitting in the middle. They need to make changes to really implement this. So we think even if the SEC approves this, it's going to be a few months before broker dealers are ready to really implement ETFs as a share class.
Interesting. Okay, and so just lastly, while we have you here, would love to get your outlook for ETFs, especially tied to commodities or even digital currencies.
Sure. I mean, we've of course seen gold be, strong this year. It's really a bunch of things. One is we've had a weaker dollar. A weaker dollar generally results in stronger gold demand because demand tends to come from emerging markets on the retail side. We've also seen central bank demand continue to be strong, partly because we think central banks want to diversify away from, just holding dollar assets and treasuries and want to be more in gold. Yeah. So that's really driving gold demand. On Bitcoin, of course, we're seeing a risk-on trade right now. So demand for Bitcoin continues to be strong. IBIT's been one of the best and most successful ETFs this year so far.
Wow. Aniket, great to have you here. Great for the insights as well. Thank you so much.
Thank you.
Coming up, full market coverage ahead in the second hour of Market Catalyst. Don't go anywhere. "90 minutes into the start of U.S. trading, I'm Brad Smith. Let's get a check of the markets here as we're taking a look at the Dow Jones Industrial Average. Take a look at them there. Losses right now by about 0.1% here intraday. The NASDAQ composite, though, that has been able to make its way into positive territory. We've been holding on to these gains. We'll put a trend chart or a trend line on that. We've been going up. We're up by about 0.7% here intraday as we're about 90 minutes into trade. And then the S&P 500, that too began the day in negative territory, but also we'll put a little bit of a technical drawing on this one, and that's been going higher over the course of today's activity. It's up by about 0.2%. And then additionally, diving a little further into the S&P 500, 11 sectors loaded up here for you on the screen. As of right now, bringing up the caboose, we'll give you the bad news first. Healthcare, that's down by about 0.8%. No doubt, perhaps a little bit of the lingering thoughts in investors' minds around how the industry could could face some significant changes driven by the bill working its way through Congress right now here, now sent back to the House. They will be reviewing, so we'll continue to track some of the sectors that are moving on the back of that. Materials, though, that's leading the pack here on the day. That's up by about 0.9%. It looks like, though, we do have more laggards than gainers as of right now. Technology is one of those laggards. Since we're talking technology, let's go no further than the NASDAQ 100 here. And taking a look at some of those mega cap tech stocks, just a little bit mixed here. Apple right now, that is higher on the day by about 2%. And additionally here, taking a look at NVIDIA, you're seeing that higher by 2.5% on the day's activity. Has continued this climb higher here. And I'll put this on a year-to-date view for you just so you could see where we are within the realm of some of those new all-time highs. We could see another one intraday here, so we'll continue to keep close tabs on that. And then also Tesla out with some delivery numbers earlier this morning. However, year-to-date still down by about 23%. We'll round that off. 2 shares higher, 3% on today's activity. And we'll round this out with a look at the Dow 30 components. We already hit some of these, so I'll put this on an equal view. And it looks like we do just barely have more laggards than gainers as of right now. The gainers look similar to the NASDAQ 100 and NVIDIA and Apple. However, the laggards, Travelers right now, Travelers Company, that's down by about 3.7% on the day. And United Healthcare, you're seeing that down by about 3.5%. Well, coming up this hour on Market Catalyst, first up, President Trump's tax bill facing an uphill battle in the House. We break down everything that you need to know about the bill. Plus, President Trump inks a trade deal with Vietnam as the self-imposed trade deadline looms. We break down the movers on the back of the announcement. And in markets, seeing near record buybacks for the most recent quarter. We break that down and much more on Catalyst this hour. Well, this morning's ADP report showed an unexpected decline in private payrolls in June. It comes ahead of the U.S. non-farm payrolls report coming from the Bureau of Labor Statistics, known in your hood as the BLS, and that will come tomorrow morning, which could have implications for the future of interest rates. Yahoo Finance's own Jennifer Schonberger has more. Jennifer, what do we know?
Hey, Brad. Yeah, private sector hiring unexpectedly contracted in the month of June, really raising questions about just how sturdy the job market is and whether the consumer can continue driving this economy. ADP out with that new report this morning that private payrolls fell by 33,000 versus expectations for the creation of nearly 100,000 jobs for the month of June. That marked the first month of job losses since March 2023, though the payroll processing firm noted that layoffs were scarce and it was more the reluctance to hire new workers or replace workers who have already left that really drove that decline. So it speaks more to that no hiring, no firing economy that we've really been seeing for months now, dating back to even the previous administration. And perhaps not all that surprising because there is a lot of uncertainty right now clouding the outlook for employers, given uncertainty around the president's policies, whether it's trade, the tax bill, deregulation. One thing that may help employers is if the tax bill gets passed, but that now held up in the House. And I think it's just really going to be lifting the uncertainty, gaining more clarity about the outlook before employers decide to pull the trigger on more hiring. And while that top line payroll number was pretty ugly on the ADP report, it's not necessarily a precursor for the all-important government jobs report due out on Thursday. Economists there are calling for 110,000 jobs to be created for the month of June. That would be a downshift from the 139,000 that were created back in the month of May. So that would continue the gradual cooling trend that we've been seeing so far over the past 3 months, albeit still show a solid job market. Meanwhile, the unemployment rate expected to tick up to 4.3% from 4.2%, which would still be historically low. Brad?
And Jennifer, we've heard from Fed Chair Powell that he wants to see if tariffs impact inflation before acting on rates. Could tomorrow's report sway his decision?
Look, I think if the report comes in as expected, it's not going to change the calculus for the Fed, because even though we could see a downshift to 110,000 jobs created, that's still in excess of the jobs needed to match population growth. So Fed officials would still view that as a solid job market. And with the unemployment rate, even though it is expected to tick up, it's not like it's all of a sudden going to 4.5%. I think if we saw a bigger leap in the unemployment rate, that may catch the attention of Fed officials.
Jennifer, thanks so much. A lot to continue to keep tabs on, even in a holiday abbreviated week for trading here.
Indeed.
And some eco data. Thank you. The June Challenger report shows employers cut just shy of 48,000 jobs in June. While that number showed a 49% decline from the previous month, it makes for the highest second quarter total since 2020. For more on the labor landscape, I want to bring in Andy Challenger Gray and Christmas Senior Vice President. Andy, always a pleasure to grab some time with you here. I just want to start off with your insights on the headline from this print and what that spells out more broadly about the state of the labor market right now.
Yeah, look, we've been seeing increased rates of job cut announcements throughout the first half of the year. A lot of that is forward looking. So while the labor market has been really resilient over the first half of the year, the job cuts that we've tracked in the future over this period lets us know that there's probably more weakness coming into the labor market. However, this month's number, which dropped pretty dramatically in June, is a good sign that it's not this vicious cycle of cutting that we can often see when things start to turn. So for us, for now, this number is indicating at least a cooling of overall activity that lets us think that this stall out could continue to be relatively positive, just a slowing of the labor market instead of something worse.
What should we make of these sectors that are making these layoffs? Because, I mean, even today, we're talking yet again about a major tech company in Microsoft that had just come off of one of its larger multi-thousand layoffs, I think 6,000 layoffs earlier in the year. And then additionally here, announcing once again, more sweeping layoffs, as the Seattle Times has reported this morning.
Yeah, the tech sector has been among the top cutting sectors now for 3 straight years, coming out of the labor shortage that we saw just after the height of COVID. There was a ton of what now seems to be over hiring in the tech sector that has been slowly being right-sized out of that industry. Though that story is running a little thin 3 years into tech cuts. I think there is some real destruction that is happening in jobs within that sector that it remains very relevant. We've also been seeing, for the number one area of job cuts is the retail sector, a sector that's hardest hit by on again and off again tariffs, slowing in consumer spending, inflation, uncertainty. That is one of those areas where a lot of the economic activity that we've been seeing is really clearly showing up in the jobs numbers.
And so all of this considered, where are we seeing resilience on the hiring side? Because we also did get JOLTS data this week. However, that does come with a more significant lag.
Yeah, we've still continued to see job hiring announcements within some sectors. We've seen this month some pretty good announcements in industrial goods, in construction. So areas of the economy where we're looking to see if there's still movement and spending and building. And since there are more hires, they're coming, it's a positive sign that there's some core of the economy that is really remaining resilient.
So is there anything within the employment data right now, in the labor market data, that you believe is enough to sway the Fed to cut earlier than anticipated? And right now, it seems like September is the highest probable month that we would see them begin what is expected to be 50 basis points of cuts through the end of the year.
Yeah, I think it would have to be pretty significant if we saw a very, very low number of jobs added or negative growth in the labor market, that would be something that would clearly indicate to them that there's a need to make quicker change. I think the other thing to continue watching out for is revisions of previous reports. We have been in a period for at least half a year now where every single unemployment report coming out of the BLS has been revised down over time. And that's a sign that the economy was a little bit weaker, the labor market was weaker than we've realized at any point in the last half a year.
Andy, good to see you. Thanks so much for the insights as always.
Thanks for having me.
Still with me, we have Brianne Lynch, who is the Equities and Head of Market Insight. Brianne, what does a softening labor market mean as related to private markets here?
Sure. So when we look at the private markets, the biggest sector that we're talking about is tech. And as Andy had mentioned, a lot of that right sizing has already happened. So there were mass rounds of layoffs coming off of the venture boom in 2020, 2021. But most of that has kind of fed its way through the market. So we're not seeing that there's more layoffs, but more people are staying put in their jobs. Hiring has slowed down a bit. The one area, though, in the tech or private market that is kind of an anomaly to all this is AI. So there's been this AI arms race for talent where, companies like Meta are offering hundreds of millions of dollars of signing bonuses for top AI talent. So obviously this is a very narrow segment and a specialized part of the market, but certainly kind of goes against some of the broader trends we're seeing.
Absolutely. It's been fascinating to track here and see some of the people who were industry specialists, experts, the best in their field, make transitions from companies like OpenAI to Microsoft and Facebook, Meta Platforms rather, and how all of those companies are talking about the talent that they are acquiring and trying to make sure it's helping them get to some of their ambitious goals with AI as well. Brianne's sticking with us. We've got much more to discuss on the other side of this short break. You're watching Market Catalysts. House Republicans are set to vote within the hour on the rule for consideration of a mega tax and spending bill. The latest version of President Trump's big, beautiful bill would add nearly $3.3 trillion to the U.S. deficit over the next 10 years, according to the Congressional Budget Office, a far steeper price tag than the House's initial version. That staggering debt load could have big implications for the U.S. economy. Joining me now, we've got Nick Timmeros, who is the chief economics correspondent at the Wall Street Journal. Great to have you here with us, Nick. What does just the tax bill mean here for the Federal Reserve as you've been able to gather your own reporting and have discussions on this?
It's hard to say. It's hard to say how much the tax bill has really entered into their forward-looking forecasts so far. Because when you think about what they're doing here, what the Congress is doing, they are really removing potential headwinds if the tax cuts didn't get extended. Obviously, there's some new tax relief in there. There are, projected higher deficits from the independent budget crunchers. So maybe you're adding a little bit of tailwind to the economy early next year. But it seems like this is really more about taking away headwinds. And so it's not clear how much that's going to change the outlook for the Fed. I would also say it's just awfully hard to sort of separate that from all the other policy experiments that we're running right now. Tariffs, which gets a lot of the attention, but also on immigration, on the cutbacks of the federal workforce and sort of the related contractor, science and tech funding complex. So when the Fed says they're studying kind of all of the policies, it's hard to figure out, well, how much does, this offset that and so forth.
With that in mind, it's never a clear-cut answer that we get from Fed Chair Jay Powell whenever he is asked about the impacts of a tax bill or the committee members' thoughts on the tax bill, and rightly so, as they want to make sure that they are coming across as apolitical and just down the middle as possible, as they are really focusing in on their dual mandate. But then we have to become maybe not concerned, but certainly monitor what trends look like as per their lens as some of these elements of a bill do take effect. How long do we typically see them wait to really show up, to really kind of solidify that a trend has shown up in the data?
Well, that's just it. I think they're just going to have to default to looking at the data because it is so difficult to, weave together all these forecasts. If you go back to 2018, after the initial Trump tax cuts were passed, I mean, the transcripts are public from the Fed meetings in 2018, the Fed staff forecasts in the Teal Book are public. The Fed staff turned quite hawkish, much more hawkish, in fact, than the committee in 2018, coming into 2018 after that was passed. I think this time is different, again, because you're not creating as many new tax provisions, you're doing extensions of existing policy, and then you just have all this other noise from tariffs, immigration, and DOGE.
And so with that in mind, how significant is it the newest voting members of the FOMC and how they are actually going to be able to play more of a role this year at a time where we are waiting for trade policy negotiations to net out in one way or the other, and then us be able to track what the impact to the consumer front and the stable prices might look like, and what policy decisions they might need to make off the back of that. Is there any significant delta in the thinking of these new voting members versus what we had seen in years past?
Well, I think it's possible that some of the people who have joined the Fed more recently, the people who weren't there for the big 75 basis point increases in 2022, they may be more hawkish. They may see this as, okay, there's inflation risk now from these tariffs, and we really have to be vigilant against that. They weren't there for maybe the mini Volcker moment that the Fed had when they got aggressive on raising rates 3 years ago. But as you look at the committee dynamic right now, I think this is still a committee where, Chair Powell is in control. He tends to get what he wants. That doesn't mean it's always, easy or without dissents. And as we've seen now with Chris Waller and Mickey Bowman coming out for a July cut, I think it raises the odds that you see dissents from here on out, at least in 2025. They don't cut in July. Well, do Waller and Bowman dissent? If they then cut in September, you could have more hawkish committee members who dissent on that. And, in the time that Jay Powell has been chair of the Fed, to my mind, the period with the most disagreement on the committee was, in fact, when they did the 3 mid-cycle adjustment rate cuts in 2019. You had about 5 Fed presidents that summer, 2 of whom were voting, that did not think it was appropriate to be lowering rates. And then you had 1 Fed president who was dissenting because Jim Bullard, the then St. Louis Fed, wanted a more aggressive path down. So I think it's, you're going to see more sort of palace intrigue, both with the president being quite vicious towards the Fed and demanding rate cuts, but also a committee that will not be of one mind over how to deal with this, unless the data is just blindingly obvious, begins to break all in one direction or the other.
With that in mind, we're going to get a key data point in the employment situation from the Bureau of Labor Statistics. What are the anticipations, especially as the setup has not been good for some of the precursory data, both in the layoffs data from Challenger that we were just discussing not too long ago. It's the highest total, Q2 total, since 2020 that we've seen. And then additionally, ADP private payrolls, that was down 33,000. So 33,000 jobs lost versus the addition that was expected of about 98,000 jobs there.
So a couple things I think about. One is that, the Fed participants this year have been talking about, they've been talking since last year really, that they expect the break-even pace of job growth to come down. It went up when we had a huge increase in immigration after the end of the pandemic. It's going down now. The Biden administration did cinch up the border last year, and now the Trump administration is doing much more public raids and deportations, and you're hearing about Hispanic worker absenteeism. And so, there's a report out today from economists at Brookings and AEI who say the break-even pace of job growth could be below 40,000. So you could see, job growth at 50,000 a month and potentially not have the unemployment rate going up. I'm not predicting that, but other people are saying that's possible. And I think the Fed has already taken that on board, that you could see that. It'll feel uncomfortable to see job growth slowing, just as it felt uncomfortable last year to see the unemployment rate creeping up. But it's going to be very hard to gauge underlying labor demand. And then the other point I would make is that it's unusual that you would see the Fed completely change what it's doing on the basis of one report. The big policy pivots that we've seen from the Powell Fed, sometimes it looks like they're doing it on the basis of one report, but it's usually revisions to past months' data. So you get a benchmark revision that says, hey, not only was job growth slower last month, but it was slower for the 6 months before that. You've seen the same thing when inflation data got revised in early 2023, and they sort of toggled from doing 25 basis point hikes to putting a 50 on the table before the SVB collapse. And so it's really just, one report might catch their attention, but what I think has really caught their attention have been a string of releases or revisions that say, hey, the whole trend looks different. And right now, the Fed has been talking about a low hire, low fire economy, and the numbers this morning, they really seem consistent with that.
Yeah, well, in the previous print, we certainly did get, to your point, some of those significant revisions that ultimately combined for 95,000 lower in the reading for March and April combined here, and we will see exactly, to your point, what those revisions look like come tomorrow, if any. Nick, thank you so much.
Thanks for having me.
Appreciate it. Coming up, share buybacks set a new record in the first quarter. We've got more on what's driving the surge. That's next. Now time for some of today's trending tickers. We are watching Netflix, Rivian, and Microsoft. First up, Netflix is upping its push into unscripted TV, reportedly exploring music shows and interviews, according to the Wall Street Journal. The streaming juggernaut has reportedly held conversations with Spotify about partnering on projects like award shows and live concerts. Netflix is also working on a pilot program with the Daily Beast, focusing on non-political news events. The company has made efforts to expand its live TV offerings in the past. Its Mike Tyson-Jake Paul fight last fall was disrupted by some glitches, though. But the 2 NFL games it hosted over Christmas, which included a Beyoncé halftime show, had minimal disruptions. Thank goodness. Next up, Rivian shares falling after announcing it produced around half as many vehicles as Wall Street expected in the second quarter. A company spokesperson said output was limited to avoid producing too many 2025 models so close to the upcoming model year change. That's later this month. Rivian reaffirming its full-year delivery guidance of 40,000 to 46,000 vehicles. High end of that range would be an 11% drop from the prior year and the company's first decline in annual sales. And finally here, Microsoft will cut around 9,000 jobs in another wave of layoffs this year as the tech giant looks to control costs while ramping up its AI spend. Microsoft recently laid off at least 300 employees in June and cut more than 6,000 jobs in May. The cuts this month will affect less than 4% of staff and will occur across different teams and offices. A Microsoft spokesperson says, quote, "We continue to implement organizational changes necessary to best position the company and teams for success in a dynamic marketplace." Across the board, the tech industry is racing to keep up with AI spend. You can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's Trending Tickers page. First quarter share repurchases setting a quarterly record, rising more than 20% from Q4, spurred on by the top 20 companies in the S&P 500, according to data from S&P Dow Jones Indices. Here with more analysis, we've got Howard Silverblatt, who is the S&P Dow Jones Indices Senior Index Analyst here. Howard, always a great pleasure to grab some insights here with you. So what is the driving force behind some of the buybacks that we've seen at this record level?
Okay, and the items are changing. Q1 companies similar to buying cars loaded up a bit more on buybacks. They were willing to do it. They didn't know what was coming down. They knew they had to get shares, employee options to negate those. So we hit a record on there. It went up. There was a lot of expenditures, again, for Q1, led by the normal run of people, the Apples and NVIDIAs were up there, but also the JP Morgans, Goldman Sachs, the financial, and they're going to be the big player in Q3. But Q1 increased as companies loaded up on shares, not knowing whether or not they're going to be able to buy going forward because of the economy, tariffs, and that potential increase in taxes on buybacks, which there was talk about increasing it. Not in either bill. We'll have to see how that works out in Washington over the next couple of days. But Q1 was the record. Don't expect Q2 to be, but Q3 and Q4 will be.
Why is that for Q2, where we did see a sharp pullback in equities?
Stocks.
Right.
Yeah.
And so with that cratering, wouldn't that...
The average, I'm sorry.
No. You might already be hearing telepathically what I'm thinking, and that is, wouldn't that cratering create an opportunity for companies who were saying, all right, we were already comfortable buying back stock in Q1. Why wouldn't we continue and execute on what had already been announced in some of our repurchase plan authorizations?
Especially when the price is average, when you do it on a weighted basis, 7% less. Get a bargain on that, but they had already loaded up. They were nervous about going forward, and they spent appears maybe about 280, 281. We're getting the reports now, so slightly less. But what they did do, because the prices were less, got more shares for their dollar. You know, there's more groceries they bought because the prices were down. So that should help Q2 EPS on there because they bought back more shares, and therefore you're reducing the share count and your EPS go up. But they definitely pulled back a little. They were more nervous about the economy and tariffs, costs, their own business supply lines than they were about buybacks. And again, they were bulked up. Q3, however, we're looking to be potentially over $300 billion, a new record on there. And that's going to be led by the financials. We've already seen financials, almost a dozen of them, increase their buybacks and dividends, and they are pushing buybacks a lot more than dividends, even though the dividends are getting the highlights on there. So we're looking for Q3 to increase on there, but with the higher prices where we stand now, again, Q2 might have been that bargain, but it looks like they're back to buying at the high side. If they're going to be increasing right now, as long as these prices, the 6,200 level is holding. So we may not get as big of a boost to the EPS, but you'll get more buying in there. But again, you're getting fewer shares in the third quarter. And fourth quarter, by the way, also, again, market holds, levels hold, earnings hold where they're about to be. At least the estimates, we'll get a fourth quarter record on top of that quarter three, which was on top of Q1. So buybacks definitely are being favored by companies more than the dividends.
So what is, and I was just about to ask you about that, what is the pass-through effect from repurchases into dividends? Because that actually decreased in Q1 by 2.1% according to your data.
Yeah, and it's expected to decrease the next quarter as dividends show modest increase. We'll do a dividend release next week for full Q2 numbers. But basically, companies continue to increase their dividends, but they did not increase them as much. They were not as generous. They were holding back. They did not want to make that cash commitment going forward. Again, my dividends, if I pay you 10 cents instead of 9, you expect that 10 cents to continue on and eventually to be 11. Buybacks, I could pull up and down by just calling the trader. Stop buying, increasing buying. Again, the plan on buybacks is not a requirement the way dividends are and a cash flow item. So companies are going more into the buybacks now that supports their stock. Okay, the question is how much of it is going to be discretionary? They always buy enough shares to negate options, employee options, because those are cheaper. I have an option that exercises at 30, the stock's 50, the company buys it at 50, gets 30 back. It only costs them 20. When they go in to reduce their share count, it costs them that full 50, and that's controlled more by the board of directors and senior management. And we're expecting the discretionary to slightly pick up in Q3 and Q4, and it looks like it decreased in Q2. Again, we'll know that over the next several weeks as the earnings come in and the actual numbers. But buybacks companies It's a shorter term, more control, turn it on and off. Dividends, a commitment forever.
Really fascinating data and insights. Howard, always a pleasure to grab some time with you.
Thank you.
We've got all your markets action ahead. Stay tuned. You're watching Market Catalysts. We're looking at the future of finance. Morning Brief Market Sunrise host Ramzan Karmali sat down with Kraken CEO, co-CEO Arjun Sethi, who is involved in leadership at several other companies at the intersection of finance and artificial intelligence. One of the other hats that he wears, chairman of Tribe Capital, a venture capital firm. Take a listen.
I wear a bunch of different hats alongside Kraken. And so at Tribe, the real goal at Tribe really was that in a world where capital is about who you know versus what you know, how do you build to be able to bifurcate against that? And the reason I say that is that we never wanted to have an entrepreneur come to us and meet with us and pitch their idea and be turned down because of what their resume was, or where they grew up, or who they are, or the color of their skin, or their gender identity. So you take all those pieces out. What really matters is what have they been working on? How is that innovation continuing to grow? How can you quantify that? And then what are the aspects that you can use to make sure that you can identify what's the specific product market feature sets that they have, and how to help them scale and grow that. At Tribe Capital, almost 20 to 30% of our capital is in emerging markets, but these emerging markets companies are just as good, if not better, than what you see traditional companies in the U.S. markets or European markets. And so our goal was to identify the best. And had we done that before? We did. We had identified Slack really early on. Before they went public, we were early stage investors at my previous firm. We had done that with Snapchat. We had done that with Square. We had done that with Lyft. We had done that with Uber. We had done that with a whole host of companies in our life cycle of not just investing, but being operators at the same time. So when you say, does AI exist? AI only works to augment something that's working. So our firm today, what we focus on is that getting the data from those companies, helping them with insights to be able to grow. And through those insights, we're able to then help think through our time, our capital, and our position to be able to get them to be as successful as possible and as large as possible.
You said earlier that you wear many hats. One of your other businesses is Termina. How did you get the idea for this?
I think if you look at Benjamin Graham and what he had done for accounting and then benchmarking, company A versus company B versus company C, and the whole world of finance that is built upon that, that is essentially what we do in the private markets and now public markets with Termina, which is all the ways in which we invested, all the ways in which we got successful at investing and returning capital to our investors. We wanted to be able to bridge that gap so that we could build software where companies can use it, other funds could use it, other folks that are asset allocating or capital allocating could use it, so that it became more of a standard in the ecosystem. And so I'm happy to say that our data points now are almost 36 million companies have interacted, and we've got data sets around how they interact with each other. And we've got a whole host of folks that think very similar to us, which is how do you evenly distribute capital to companies that are worthy or need it, rather than companies that just have a good pitch but not a good product.
And that's not all. Arjun Sethi is also the co-founder of Capital, a bank and tech platform that leverages AI to support small and medium-sized businesses and their operations. Sethi explained why he sees opportunity in that space. Take a listen.
So look, one of the most exciting things about where I get to sit and who I get to work with is that we get to meet with entrepreneurs that have a vision every single day. And then on the other side, and they build great products and they build great software for their customers. And on the other side, you have us as asset allocators that have built companies before, that have scaled them, in some cases to tens of billions of dollars in enterprise value, that have built a roadmap in the way in which we think companies should be built. It doesn't mean it's right or wrong, it just means that it's worked for us in the past. And so what we decided to do is, for a lot of these emerging markets, we used our same infrastructure for how we think about quantifying product market fit or quantifying health of a company. And we started looking at emerging markets that need, again, access to capital. What are the ways in which to do it? But it's not just for startup companies. It's for the mom and pop shop. It's for someone who rotates tires. It's for someone who owns a travel agency. And in a lot of these emerging markets, in the case for Capital, we had a pretty unique value proposition for what we believe we could deliver by being a bank and building software around a bank, bottoms up, right from the beginning, software that was attuned and articulated for those customers, where they could do payroll, where they could lend, where they could do payroll advance on behalf of their employees. They could do expense management in a way where they don't have to go and buy some third-party services that are not for them, but it might be for a U.S. customer. So we built a bank from scratch, ground up. We built the Rails from scratch, ground up. And we built a software to be able to touch now, I think almost over a couple 100,000 merchants just in Mexico, Colombia, and Peru. And then these merchants are able to deposit, they're able to lend, to be able to take loans against their assets. They're able to do now employee benefits and payroll, everything that they need to do to be able to be successful.
And that was an excellent conversation here. I just want to continue the conversation here with Brianne Lynch, who is the Equities and Head of Market Insight. And one of the amazing areas that we've been tracking is the not just market reception to some of the strategic plays around cryptocurrency, but the other potential players that are still waiting in the wings to make a market entry. Circle was successful, but are there others that are in the crypto landscape, either platform or crypto touching and holding, that you think could receive a solid market reception here?
Sure. So Circle's IPO was really this big vote of confidence for the crypto and stablecoin industry at large. And they really timed it well when you think of some of the bigger macro pieces at play. You have a crypto-friendly administration in place. There's stablecoin legislation out now that is really legitimized stablecoin. And then you have some of the biggest banks and retailers in the world talking about launching their own coins. Coinbase is now an S&P 500 company. So all of these things are tailwinds to support these companies. When you look at others that might follow, Gemini is one that has confidentially filed. But several other of the top players in the private markets are continuing to grow. Kraken, we just talked to the co-CEO there. Ripple and others are really growing in the private markets. And another lens on that is, this idea of how tokenization can play a role in broadening access to the private markets, and that's something that the SEC chairman actually talked about this morning. It's
going to be fascinating to see how many of those companies are able to leverage this moment and this momentum and perhaps appeal to some of the investors in public equity landscape right now. Brianne, thanks so much for joining me here today. It's been a pleasure to have you and grab some of your insights. I've had a front row seat to your knowledge, and I appreciate it.
Thank you.
Absolutely.
Great to be here.
Brianne Lynch of Equities and Head of Market Insight. And coming up, everyone, a big change coming from millions of retirees, and it has nothing to do with the tax bill working its way through Congress. We've got the details next. Every year, the Social Security Administration issues nearly $1.5 trillion in benefits to 73 million recipients across the nation. And for 2 million of them, those payments could be cut in half as soon as this month. For more, Yahoo Finance senior columnist Carrie Hannon joins me now. So Carrie, why is the government cutting these benefits?
Yeah, Brad, this is something that's been in the works for a while, and it's actually been going on. It's the amount that Social Security overpaid people in their Social Security monthly check. And that could have happened because the agency miscalculated how much someone could get paid, or a beneficiary didn't notify the agency when they had a change in their income. So this impacted quite a few people. And by law, the agency has to recoup these overpayments. So in order to do that, it had been at 10% of each check until the total amount had been paid back to Social Security. But in March, the Trump administration announced it was going to be 100% until it got paid back. Now, that caused a lot of alarms to go off, and people were pretty frightened because if they depended on their Social Security check to pay their monthly bills, this was a big deal. A couple of weeks later, in April, they backed down and said, okay, it's going to be 50%, and this is going to start in July. So during this month, probably towards the end of the month, these checks are going to start being clawed back, is the term they like to use, but it's giving the government back money that was overpaid.
So if you received an overpayment, what steps can you take?
Brad, there are things you can do, and you should have received a notice. They give you a 90-day notice. And the steps that you can do are go to the Social Security website, and you can, if you can, pay it. Just pay it by credit card or by check or what have you. If you can also ask for them to make it smaller amounts, and that you have to file a form to make that request, and you have to have documentation. I presume, I don't know exactly what you need, but they will consider smaller payments. You can also ask them, that you just actually want to waive it because you don't believe it was your fault that you were overpaid. Or you can file for what is called a reconsideration, which is basically saying you don't think that the calculation was wrong. So there are a couple of steps, and I encourage people that if they need to do so, please take action and see what you can push forward, because for many individuals, this can be a big chunk of their monthly check.
Carrie, thank you so much.